So this video is going to be walking you through both the direct and worksheet approach to consolidation. If you want to follow along, I am going to be walking through problem 3-7 on page 142. The July 31st Year 3 balance sheet of two companies that are parties to a business combination are as follows, and I put this information on my Excel sheet on the screen. In addition to the property, plant, and equipment identified above, Red Corp attributed a value of $100,000 to Sachs's assembled workforce. They have knowledge and skill to operate Sachs's manufacturing facility and are critical to the success of the operations. Although the 8 manufacturing employees are not under any contracts, management of Red was willing to pay $100,000 as part of the purchase price on the belief that most or all of the employees would continue to work for the company. Effective August 1st, Year 3, the shareholders of Sachs accepted an offer from Red Corp to purchase all of their common shares. Red's cost for the investigating and drawing up of the purchase share agreement amounted to $18,000. So we are not dealing with part A in the required. Let's hop straight to part B. Assume that Red issued 120,000 common shares with a market value of 8 per share to the shareholders of Sachs for 100% of their shares. Legal fees associated with issuing these shares amounted to $6,000 and were paid in cash. Red is identified as the acquirer. Prepare the journal entries in the records of Red to record the share acquisition and related fees. And then part 2 is going to be prepare a consolidated balance sheet of Red as at August 1st, Year 3. So try not to get overwhelmed by the amount of information thrown at you right off the get-go. Let's take it step by step. So first things we want to look at is, hey, let's record that initial investment. So we have our journal entries. Investment in Sachs. They told us it was 120 shares at 120,000 shares at $8 per share. So the math right here, 120 times our 8, 960,000. We were also told in the last paragraph that they had some sort of professional fees for drawing up the agreement of $18,000. So professional fees, and this will be an expense, I'm just going to jot that right there, of $18,000. Now there was also legal fees that they mentioned of $6,000, and that was just associated with issuing these shares. Now, the fact that there was legal fees associated with issuing the shares rather than drawing up the agreement, the issuing is a direct offset to the common stock. So what we're going to do here now is common stock would normally be just the 960. However, considering 960. However, since we did get those shares and those legal fees associated to them, we want to deduct it directly off of common stock. And the last little bit was paid in cash, and it told us that in the question. So that another way to look at it is that's the 18,000 plus the 6 was paid in cash. That is our initial entry to record Red's purchase of the shares and any related fees. Now the fun stuff begins on the consolidation. We need to first figure out where are we sitting with our acquisition differential and our goodwill. First piece of information we need to find is our purchase price. Well, we know from above it's $960. Actually, I'm going to move this over just a little bit so we can have a little bit more room to play here. $960. We also know that the book value of the assets. So I'm just going to write book value. Now this information you can find from, I'm going to scroll up a little bit, Sachs's balance sheet. It's going to be the 168 for their common shares plus the retained earnings. So the book value is at 648. This means that the acquisition differential is the difference between these two figures, the 960 less 648 gives us 312,000. So this 312,000 now needs to be further split up between what's associated with the fair value increments and goodwill. How we do that is we're going to be heavily relying on the information up here between the carrying amount and the fair value. So let's leave a little bit of space, and we're going on to fair value increments. So we have a number of items listed up here. I will copy them one by one as we see fit. So current assets. Is there a difference? Yes, there is. So let's copy that one down. And I'm just going to go like this and copy actually both of this. It'll be easier this way. Next one, what do we have going on? Oh, our PP&E. There's a difference there. So let's copy our PP&E down. Next, the patents. There is a difference because we have nothing on the books but a fair value of 72,000. So let's just do that. After that, let's look to our liabilities. We do have some discrepancies there, and so we need to ensure that we're capturing our liabilities. The current one is okay. You can see that there's no difference, so there's no point copying it down just for the sake of copying it down, but our long-term debt, we do. So we'll grab long-term debt, bring it down, also grab the carrying amount and the fair value, copy that down. Now remember that liabilities under the fair value increments will be appearing as negatives. Don't forget to change them. This can really sort of mess around with your formulas if you don't. So we have our assets, we have our liabilities. We know the difference will be going to goodwill, so we may as well just jot it down. Now, the calculation or the formula up here is fair value less book value. Book value is the same as the carrying amount in our case. So we have fair value less book value. May as well add it as a formula and just drag it down. Now, you may be wondering, hey, Erin, what about that $100,000? The $100,000 pertaining to the employees, we have to think back to our prior accounting courses. It would only be recorded as part of the fair value increments if it qualified as an intangible asset. So in order to meet that criteria, it needs to be identifiable. So that really means, does it have a contractual or legal right? In this case, in the question, it specifically tells us they do not have any employment contracts. So as a result of that one statement, it doesn't qualify to be included as part of the fair value increments, and we just ignore it. Don't capture it at all, and sort of move on with the question. So now going back, we have sort of a subtotal going on here. So let's see what we're sitting at. Want to add all of these up. Gives us 228. Well, we know up here our initial acquisition differential is 312. The difference between the two is the amount that's going to be allocated to goodwill. Now that we have our goodwill portion and all of our fair value increments, we actually have completed a good portion of the steps we need to do in order to prepare a consolidated balance sheet.